You wake up and your phone is already buzzing. Market's down hard. Your portfolio is red. Your job Slack is quiet in a way that feels wrong. And somewhere in the back of your mind, a cold realization settles in. This crash is not going to look like 2008. And that's exactly why most people are about to get wiped out. I know what you're thinking. You've seen crashes before. You survived 2020. You watched 2008 in documentaries or lived through it and made it out the other side. So this time can't be that different, right? That belief is the trap. In 2008, the danger was loud. Banks failed on TV. Lehman collapsed. The system cracked in public. You knew where the fire was. You could see it. You could react. This time, the fire spreads quietly. Through inflation, through debt, through stagnant wages and rising taxes, through markets that don't crash straight down, but bleed you slowly while convincing you everything is fine. And that slow bleed is more dangerous than a sudden collapse. Here's the problem. Most investors are positioned for the last war, not the next one. They're waiting for a dramatic crash so they can buy the dip. They're holding assets that only work in stable growth with low rates and cheap credit. They're leveraged emotionally, financially, and psychologically. And when the system shifts, they won't even realize they're losing until years are gone. The real threat isn't just the market dropping, it's inflation staying high while asset prices stagnate. That's a silent confiscation of your time and purchasing power. If your portfolio goes nowhere for 5 years while inflation runs at 6%, you didn't break even. You lost nearly a third of your real wealth. That's math. That's reality. And nobody rings a bell when it happens. Meanwhile, layoffs don't come all at once. They come in waves. White-collar jobs that once felt untouchable get trimmed. Contract work dries up. Promotions disappear. Suddenly, your income is less predictable right when your expenses are locked in. Mortgage, car payment, subscriptions you forgot you had, lifestyle costs that quietly assumed the good times would last. Debt turns from a tool into a weapon pointed at your future. This is where most investors get wiped out, not by panic selling, but by forced selling. You don't sell because you're scared, you sell because you have to. Rent is due. Interest rates reset. Your emergency fund evaporated months ago. And here's the dark joke of it all. The system doesn't need you to fail fast. It just needs you to fail slowly enough that you blame yourself instead of the structure. Now, let me talk about the internal threat, because this is where it really gets ugly. When uncertainty drags on, discipline breaks down. You start chasing returns. You jump into whatever worked last year. You overtrade. You undersave. You convince yourself one big win will fix everything. It won't. Volatility punishes impulsive behavior. Sideways markets destroy undisciplined minds. This is where fear and boredom team up to empty your account. So what do you do when the next crash doesn't look like a crash at all? You stop thinking like an investor first and start thinking like a survivor. Survivors don't maximize returns, they minimize ruin. That means your first priority is not growth, it's liquidity, cash flow, optionality, the ability to make decisions without being forced. If you can't go 6 months without income, you're not an investor, you're a hostage. This is where everyday income sources matter more than market genius. Skills that convert time into money. Services people still pay for when budgets tighten. Work that doesn't depend on bull market optimism. You don't need a side hustle that sounds impressive. You need one that pays reliably. Boring beats clever in a downturn. Next, you reduce fragility. That means fewer fixed costs and fewer promises made to your future self. Every recurring payment is a bet that your income will stay stable. In this environment, that's a dangerous assumption. Then you rethink what safe actually means. In 2008, cash was trash because deflation hit. This time, cash bleeds slowly, but leverage bleeds faster. Assets that rely on cheap money are not defensive just because they're familiar. Real safety is diversification across time, income, and control. Some assets for growth, some for protection, some for flexibility, and yes, some dry powder for opportunities that only show up when others are forced to sell. Because here's the other side of this story. Crises don't destroy wealth evenly, they transfer it. Every downturn creates discounts, not just in markets, but in businesses, skills, and labor. The people who survive with liquidity and clarity don't just recover, they reposition, but only if they didn't blow themselves up emotionally first. The final threat most people never see coming is psychological exhaustion. Years of uncertainty make you complacent. You stop adjusting. You accept decline as normal. That's how decades disappear. I don't want that for you. This next crash won't announce itself with sirens. It will whisper. It will normalize pain. It will reward patience and punish denial. If you're waiting for the moment where everything is obviously broken, you'll be too late. But if you prepare now, reduce fragility, build cash flow, control your risk, and stay mentally flexible, you don't just survive what's coming, you gain leverage when others lose it. And in the end, that's what decides who gets wiped out and who walks away stronger while everyone else is still asking what went wrong.